Ladies and gentlemen, good day and welcome to Max Ventures and Industries Limited Q4FY21 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sahil Vachani, MD and CEO, Max Ventures and Industries Limited, for his opening remarks. Thank you, and over to you, sir.
Thank you. Good afternoon, ladies and gentlemen. Thank you for joining us on the Max Ventures and Industries Q4 FY21 conference call. Along with me, I have our CFO, Mr. Nitin Kansal, Mr. Rishi Raj, who is the Chief Business Development Officer, Mr. Ramneek Jain, CEO of our packaging business, Rohit Rajput, CEO of Max Asset Services, and Nitin Thakur, Director, Brand and Communications of Max Group. We also have SGA, our investor relations advisors, on the call. Thank you everyone again for joining the call, and I hope you and everyone around you is safe and in good health. Let me give you the key highlights for the quarter gone by. I'm absolutely very pleased and delighted to share that Max Ventures has reported very strong performance in revenue and profitability during Q4 and for the full financial year. In the quarter end in Q4 FY21, consolidated revenue increased by 30%, EBITDA increased by 39% year-on-year, while profit after tax grew by more than 9x year-on-year. During FY20, the company had recorded a one-time revenue of 3.57 billion on account of sale transactions at Max Towers. Adjusting for that, for FY21, revenue increased by 14%, EBITDA increased by 65%, while profit after tax grew by more than 6x year-on-year. Our packaging films vertical, Max Specialty Films or MSFL, continued the strong business momentum with posting its highest ever revenue and EBITDA for the quarter as well as for the year during Q4 and FY21. It has crossed rupees 3 billion revenue and 10 billion revenue milestone for the first time in a quarter and a year respectively during Q4 and FY21. It recorded a revenue of 3.1 billion during Q4 and 11.1 billion in FY21. This was accompanied with strong EBITDA margin expansion of 610 basis points year-on-year to 17.9% in Q4 and expansion of 730 basis points year-on-year to 18% in FY21. Coming to the real estate side, leasing revenue in commercial real estate business continued to build up throughout the year, with the exception for March 2021, where obviously new lease transactions were temporarily deferred due to the second COVID wave-induced lockdown. Max Towers has reached a more than 90% occupancy levels. Our focus now will be on leasing Max House Okhla Phase 1, continue timely construction of Max Square, and commence work on Phase 2 of Max House. In addition, we are continuing to see growth opportunities in the commercial real estate space in the National Capital Region. After a careful study of the market trends and in line with our stated strategy of focusing on one region but being across multiple asset classes, I'm happy to announce that we have decided to foray into the residential segment in Delhi NCR. We believe the residential real estate market, after a long slump, is finally coming out of the woods at the back of a cleaner regulatory environment, a preference for trusted developer brands, increased affordability due to lowest ever home loan interest rates. COVID, in our view, has accelerated the shift to credible corporate developers, focusing on overall well-being and experience of residents. This is a brief snapshot of where Max Ventures as a company stands today. We believe we are at an inflection point where our real estate business is now ready to take off, while our packaging business is expected to continue the robust performance. In our real estate business, we have demonstrated our execution and leasing capabilities through Max Towers. We successfully managed to almost fully lease out Max Towers, complete construction of Phase 1 of Max House, and also commence construction on our third project, Max Square, all of this amidst challenging macro and micro environment conditions. Going into FY22, while we will continue to add marquee commercial projects in RKT each year, foraying into the residential real estate will open up new opportunities and will enable Max Estates to become one of the leading and most admired developers in Delhi NCR. We expect a strong performance in our packaging business to continue, as well on the back of strong demand, improved realizations, and a continued focus on specialty product mix. With the new cast polypropylene or CPP line and the second metallizer line planned to be commercialized during FY22, our scale of the packaging business will enhance with improved specialty product capabilities, leading to sustained growth in revenue and profitability going ahead. With both our core businesses in a very strong position, we are confident to deliver on our strategic objectives of FY22. With this, now let me hand over to my colleague Rishi for the real estate business highlights. Thank you.
Thank you, Sahil, for the quick overview. Let me now give you some deeper insights on our real estate business. FY21 had been no doubt a challenging year for the commercial real estate business globally. Due to the COVID-19 lockdown and work from home, leasing transaction in commercial real estate industry did get impacted. As we approached the second half of the year, it was clear for most of the occupiers that only work from home could not be the sustainable option, keeping in view the long-term growth and productivity of the company. We have already witnessed during the year corporates forming a combination of office and work from home policy for employees, and we believe a hybrid workplace model most likely will be the way forward. The mix will evolve and will vary from country to country and from sector to sector. Some companies, while reducing the total office space requirement, have upgraded to Grade A spaces to increase focus on employee well-being and to spaces that enable community, collaboration, and innovation, the future of office. Seeing the hiring trends in IT/ITES space at the unprecedented levels and evidence of return to office in developed economies with higher penetration of vaccination supports our mid to long-term positive outlook for office space. In spite of challenging times during FY21, we are delighted to share that we have been able to almost fully lease out Max Towers. Overall, Max Towers now enjoys an occupancy of more than 90%. Leased area owned by Max Estates in Max Towers is now more than 95% occupied, and there was zero loss of any clients. In terms of leasing area for office spaces, we have leased out a total of 4.76 lakh square feet in Max Towers, and 2.87 lakh square feet of Max Estates owned area in Max Towers is leased. In FY21, we leased out spaces to many renowned corporates, including Cyril Amarchand Mangal Das, Yes Bank, DBS Bank, to name a few. With improved occupancy, we witnessed building up of the lease rental income at Max Tower, which increased by 74% year-on-year to 171 million in FY21. Going into FY22, we expect near full potential lease revenue accruing from Max Towers. We also completed the launch of Phase 1 of Max House in FY21. As Max Towers is fully leased now, our focus has shifted to lease out entire Max House Phase 1 during FY22. We expect to start the work on Phase 2 of the project during first half of FY22 itself. Work on our third commercial project, Max Square, continues to be on track in spite of challenging situations, and we expect to complete the development as per budgeted timeline by Q4 of FY23. With respect to our Delhi 1 project, we are still awaiting NCLT approval on the same. These were the overall updates with respect to our existing project. Now let me spend some time on our future growth pipeline. Let me break this into commercial real estate and residential real estate. Let me first start with commercial real estate. Beyond Delhi One, we have a strong pipeline, strong existing project development pipeline at various stages of engagement, including due diligence. Our focus will continue to strengthen this project pipeline, adding projects in the size of 0.5 to 1 million square feet with initial focus on Gurgaon. Our development model remains the same as we are evaluating opportunities in advanced stages in partnership with institutional investors, which will enable us to take larger projects and expand our portfolio simultaneously. With this, while our existing project will continue to build up and lease, our new project development pipeline will ensure that our visibility for future projects remains strong. Now, coming to residential real estate segment. Sahil has already mentioned that we have decided to foray into residential real estate, and we believe this will add to the growth of the company going forward. As we have mentioned in our past calls, we have been constantly evaluating trends in other asset classes in Delhi NCR and wait for entry at the right time. With demonstrated success and path to scale commercial real estate footprint, we believe, having carefully studied the market, the timing is right to foray into residential real estate. Residential market in Delhi NCR, as you all know, especially had been fraught with oversupply, incomplete projects, unfulfilled promises to the customers in terms of delivery due to unscrupulous developers and several, despite good intent, now in distress due to over leverage. As a result, people had serious trust deficit in residential real estate sector. Over the last couple of years, market has seen a sea change for good in terms of regulatory environment, affordability at all-time high due to price corrections, growth in underlying income, and low home loan rates. Naturally, the customer's preference has shifted to trusted, organized developers for their residential needs. COVID-19 has led to a shift in customer preference for bigger homes with ecosystem of amenities enabling overall well-being and above all, focus on human experience, which a local developer finds very difficult to provide. This collectively, in our view, presents the right entry circumstances for us and give fillip to Max Estate's growth trajectory, while benefiting from diversification and leveraging synergies across the portfolio. In addition, Delhi NCR as a market presents significant opportunity for consolidation and higher share for credible corporate developers. At a pan-India level, for example, total number of developers have halved since 2012, and that proportion for Delhi NCR is significantly higher, which makes Delhi NCR a very ripe region for consolidation. Hence, we have decided to foray in residential segment, focusing on higher end of mid-income target segment. Although we cannot disclose specifics right now, but we are prospecting well-priced and located clear land parcel in Delhi NCR, particularly Noida and Gurgaon. And we hope to be able to announce our first residential project in coming quarters. We are in an extremely exciting stage in our real estate business, with commercial real estate business shaping up well. And now, with foraying into residential real estate business, we aim to become one of the leading multi-asset class real estate developers focusing in Delhi NCR region. Now, let me hand over to Rohit.
Thank you, Rishi. Let me give brief highlights about Max Asset Services and MaxI. FY21 had been a good year for our facility business under Max Asset Services. We also launched our managed office space business under the brand name Workwell Suites at Max House during the previous quarter. Here, we cater to the corporates who are looking for flexible office space and don't prefer to have a long-term commitment in terms of lease. During Q4 FY21, we have signed up a total of 25 seats to 2 corporates at our WorkWell suites at Max House. As the economy has started to unlock again, we expect good traction in our managed office space business, driven by demand for flexible office space. We've also organized vaccination camps for our employees and families of Max Group, our tenants and partners, so as to enable them to resume office early as well as safely. More than 85% of our employees are now vaccinated. Revenue for MAS increased by 29% year-on-year to rupees 33 million in Q4 FY21, while it increased 75% year-on-year to rupees 128 million in FY21. As tenants start resuming office in the coming months gradually and avail facilities of Max Asset Services, the business is expected to ramp up swiftly in the coming months. With respect to MaxI, we have transferred our investment in Azure Hospitality from MaxI to Max Asset Services as a part of tax planning. We will plan to monetize this investment at the right opportunity. Now let me hand over to Mr. Ramneek Jain.
Thank you, Rohit. Let me speak about our packaging film vertical, that is Max Specialty Films Limited, MSFL. Q4 and FY21 has been the best year for MSFL in its history. MSFL continued to witness strong business momentum and recorded its highest ever revenue and EBITDA for the quarter as well as for the year. MSFL revenue increased by 34% year over year and EBITDA increased by 105% year over year in Q4 FY21. For the whole year FY21, MSFL revenue increased by 15% year over year and EBITDA increased by 94% year over year. EBITDA margins expanded by 610 basis points year over year in Q4 FY21 to 17.9%, while for the full year, it expanded by 730 basis points year over year to 18%. The sustained momentum in revenue and profitability growth in the business is on the back of strong demand, improved realizations, better specialty product mix, and stable raw material prices. With consistent efforts by the team, working with leading FMCG companies for their specialized packaging needs, we have increased our volume and revenue contribution from specialty film segment. Total volume for Q4 21 increased by 7% year over year to 15,987 metric tons. Our focus is on improving output of value-added specialty films versus the total output to improve the profitability and ensure most efficient utilization of our facilities. Value-added specialty films contributed 52% of total volume in Q4 FY21 versus 48% in Q4 FY20. For FY21, specialty films contributed 45% to total volumes versus 42% in FY20. Value-added specialty films contributed 58% to MSFL's revenue in Q4 FY21 versus 55% in Q4 FY20. For FY21 whole year, specialty films contributed 53% to total MSFL's revenue versus 48% in FY20. We had also recently announced a new CPP line, which is cast polypropylene line, which will expand the total capacity by 7.2 thousand tons per annum of CPP, and also commercialized first of the 2 new metallizers lines to enhance our specialties. With the expansion of the new CPP line, together with the increasing specialty product capabilities through metallizer lines, we are well placed to capture the new growth opportunities, enhancing the scale of the business and sustainably improve the profitability through better product mix. We expect the strong business momentum to continue in FY22 on the back of strong demand, higher realization, optimum capacity utilization, and increased contribution from specialty films. All these factors collectively will lead to significant revenue and EBITDA growth. The strong cash flows will be used to fund the CPP and second metalizer line and reduce MSFL's debt by about 1 to 1.25 billion from existing rupees 3.25 billion. Now, let me hand it over to Mr. Nitin Bansal.
Thanks, Shamnik. Good afternoon, everyone. Let me give you the financial highlights for the quarter 4 and full financial year FY21. I'll first start with the quarter 4 and then move on to the FY21 numbers. The consolidated revenues increased by 30% year-on-year to rupees 328 crores in quarter 4 FY21. The consolidated EBITDA increased by 39% year-on-year to rupees 49 crores in quarter 4 FY21. The consolidated profit before tax stood at rupees 30 crores in quarter 4 FY21, almost 4x of the same quarter previous year. The consolidated profit after tax stood at rupees 33.6 crores in quarter 4 FY21, a growth of more than 9x. Now let me come to the full year coverage of 2021. During the financial year FY20, the company recorded a one-time revenue of rupees 357 crores on account of sale transactions at Max Towers. The below highlights are adjusted for these transactions for relevant comparison. The consolidated revenues increased by 14% year-on-year to rupees 1172 crores. The consolidated EBITDA increased by 65% year-on-year to rupees 198 crores. And the consolidated profit after tax stood at rupees 57 crores in FY21, a growth of more than 6x. Now let me give you a brief segmental financial highlights for FY21. Our real estate business, that is Max Estates Limited, revenue stood at rupees 39.8 crores in FY21. The lease rental income for the financial year stood at rupees 17.8 as compared to 9.8 crores in FY20, an increase of 182% year-on-year. This is on the back of the improved occupancy levels at Max Towers. Revenue for the facility management business, Max Asset Services, for FY21 stood at rupees 13 crores as compared to 7 crores, up by 75% year-on-year. Our packaging films vertical revenue increased by 15% year-on-year to 1,114 crores. EBITDA for the packaging business increased by 94% year-on-year to rupees 200 crores. EBITDA margins for the packaging business expanded by 730 basis points year-on-year to 18%. Speaking about our liquidity position, gross debt in our real estate business, Max, stood at rupees 150 crores as on March 21, against which we had cash and liquid investments of rupees 8.5 crores. Thereof, the net debt continues to be less than 65 crores. Gross debt in the packaging film business stood at rupees 327 crores, and on a net basis stood at rupees 323 crores. We have reduced our gross debt in packaging business by more than 100 crores during the year and will continue to reduce it with a strong free cash flow generation from the business. Now I will hand over the mic to Faizan to continue with the Q&A session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Shriram Rajaram from Ratnatraya Capital. Please go ahead.
So thank you for the opportunity. I have two questions. One is on the commercial space. So what is the grade A vacancy level in the micro market which you operate? I mean, like how has it moved pre-COVID till now, especially in areas where Max House and Max Square are? That's my first question. My second question is, you mentioned in the opening remarks that the residential RE in NCR region is reviving. So, what exactly, what gives you this confidence? Like, if you could explain what has changed with reference to two things. One, what is the average rental yield in those areas, where your resi projects are going to come up? And secondly, if I just go back to slide number 22, where you have just projected where the historic months to sell is still there. It's at 41 months. So how should we look at this data point?
Yeah, I'll take both the questions. I think this is Rishi. On question one, with respect to grade A occupancy, excellent question. If you look at the face value vacancy level in NCR, Gurgaon, Noida, those numbers will be in the range of 20 to 25%. However, the key is when you peel the onion and you look at developer-owned and developer-managed buildings, in these micro markets which we are targeting, those are in low single or early double digit, 8 to 12% vacancy level. As far as these buildings are concerned, our understanding is, also going by our experience, people have been able to preserve the occupancy level with maybe some basis point difference in these grade A office spaces. Of course, the strata sold not so good quality buildings have faced rental pressures and vacancy pressures. Just to remind all of us, we as Max Estate are coming up with grade A plus, focusing on employees' experience and well-being. And this is exactly the reason why in FY21 we were able to lease more than we were able to lease in FY20 and at a higher rental than what we did earlier. When it comes to residential space, the confidence comes from multiple sources. Number one, if you look at the data with respect to what has happened on number of months to sell inventory at pan-India level, as well as when it comes to Delhi, if you look at the data for last several quarters, the inventories have corrected, number one. Number two, why this is really happening? This is happening because of affordability is at all-time high. The data we have provided in our presentation, the home loan rates are at all-time low. The prices have corrected. And above all, if you look at what's happening, where the most important piece, and this being a micro market play, you will need to peel the onion and realize the most important piece is in each micro market, the demand is shifting towards grade A credible developers who have got balance sheet strength and who are delivering what they are promising. So that's where we derive the confidence. As far as rental yield in specific is concerned, I do not think there is at a meta level rental yield in pan India or Delhi NCR micro market has seen much correction, and hence the play, we are still not very confident of the play when it comes to rental in residential space. I think the play pretty much is to capture the share where demand is looking for credible corporate developer coming up with good quality houses. So let me pause with that and happy to have any follow-up questions.
Yeah. So two things, sir. So one is you mentioned on the commercial front, you mentioned that it's in single digit. Now, how has it been, let's say a year back pre-COVID? I just want to get some sense on that. And then again on the residential space, you mentioned that the micro market we have to look at that. So what would be, let's say, if you can, I don't know whether you can give a number, but if you give a number it will be useful. I just want to get a sense of what is the share of this grade A developer in, let's say, this 41 months inventory which we are talking about in NCR region. If I just come to the micro market, what would be that number?
Yeah, so let me again try to address both the questions. I think number one, when it comes to vacancy level for grade A plus corporate, that has not materially changed pre to post COVID. and you will need to really look at developer by developer, building by building in those micro markets, which we constantly evaluate. When it comes to residential, and your question is, if you peel this 41 months, and if you really look at credible developers in select micro markets, let me just take an example. Let's take an example of Sector 150. And if you look at the data in Sector 150, and if you look at top developers who are selling in Sector 150, let me just say that they have been very successful in clearing their inventories post-launch. On an average, our research and data suggest that they are able to clear all their sales during the construction cycle, which is what one would look to underwrite at.
Okay. Thank you so much, sir. I'll join back.
Thank you. The next question is from the line of Venkatesh from Logic Tree Capital Advisors. Please go ahead.
Hi, Sahil, Nitin, and the team. Best wishes on an excellent performance in a tough year. I have two primary questions. One is on the real estate side. If we are able to get the NCLT clearance, can you give us some sort of a timeline on when do you expect the clearance? I know it's a tough question, but and if it gets clear, what would be the timeline for executing that project, and what kind of cash flows do you expect out of that particular project? Which is, I'm talking about the second phase of Max Towers, Delhi 1. And the second question is with respect to the residential real estate space, what kind of land parcel are you looking at? Can you give us some sort of a vision over the next 1 or 2 years where you want to be, and how would you raise the capital for that? Were you able to get my question? Hello?
Yes. Hi, Venkatesh. I'll take that. This is Sahil. I was able to get the question. Thank you. So the first question in terms of the Delhi 1 project that is an NCLT, the truth is it's tough to give an exact timeline. Unfortunately, due to the lockdowns, courts have not been operational and have been only hearing what they classify as urgent matters. My sense is it would still take us anywhere in the range of 12 to 18 months to be able to take this to its logical conclusion in terms of the Delhi 1 project. Second question that you had was in terms of the commercials for the project. We are underwriting each of our projects at the very least a 20 to 25% IRR. So that is what we are looking at. We believe that in the Delhi 1 project, particularly where Max Towers is, there is a significant opportunity within Max Towers as well for us to re-rate rentals, given from where we started leasing and where our last lease was. So that's the broad update in terms of the Delhi 1 project timelines and commercials. On the residential, Rishi, would you like to take that one, please?
Yes. On residential, let me divide the response into few parts. Number one, where do we want to play? We would like to play in Delhi NCR, starting with select sectors within Noida and Gurgaon. We are very carefully evaluating it at a very granular micro market level. Just to give you a confidence, if you look at Gurgaon, we are evaluating at a road level, like Golf Course Extension, Southern Periphery, Dwarka Expressway, select pockets within Dwarka Expressway. So we are really going very granular in terms of picking the location per se. Number two, who do we want to target? We would like to target high end of mid-income segment. Our ingoing view is that we would like to target, by and large, if I say, into a price bracket of 7.5 to 12,000 kind of a price bracket. But of course, it could vary from opportunity to opportunity. Third, in terms of business model, as we have started the scan and as we have started the discussions, we are open, like on the commercial side, on multiple models. including joint venture or joint development as well as outright purchase. The capital requirement will vary depending on the business model and exact location, as you would agree. But again, in residential space, our approach will be to partner with institutional investors and make our exposure, relatively speaking, capital light and thereby use that as a way to expand. In terms of our vision is to add 0.5 to 1 million square feet a year, which can translate into 300 to 600, give or take, kind of a unit in a single phase or in a single development. And as we have looked at the data of successful developers, micro market by micro market, what we have realized is if you really go conservative in your underwriting, this is a very sweet spot in terms of the launches and market's ability to absorb. So that would be our response. Hope that clarified your query.
Yeah. The 0.5 to 1 million square feet is per annum?
Per annum, yes.
Per annum is what? And when is your expected possible launch of this project?
So the first, we would come back and share with you in next, hopefully next couple of quarters. Okay,
sounds good. Just one quick follow-up question and then I'll join the queue. Packaging films, I think you've started a new line. What kind of top line can it produce? When is it expected to commission? Hello?
Oh, sorry, I think Ramnik, can you go ahead and take that, please? Thank you.
Sorry, I was speaking on another line. Thank you for the question. So the CPP line, the cast polypropylene line, should give us additional revenue of about 45 million. I think this is per month kind of a thing. So it should commence sometime in third quarter of FY22.
Third quarter?
So Venkatesh, if I can just clarify, we can expect a revenue of close in excess of 100 CR to come from the CPP line when it's fully stabilized. And what we're expecting is by the end of this financial year, we should have this line operational, and the numbers should start to reflect on the next financial year.
Next financial year. Okay.
Yeah. I'd like to add one more thing with regards to Delhi, the Delhi case of NCLT.
Yeah.
I think I'd like to highlight is over here that the court run process is something which is not something which we can control. But in our journey for the commercial real estate, we have started to put the pedal on the new project acquisition. If you see on the slide 34 of the presentation, we have disclosed a number which is in excess of $7 million, 7 million square feet, which we are actively pursuing for our expansion on the CRE front.
Right. Understood. Yeah. No, that's helpful. Thank you. I'll join the queue. Thanks. Yeah.
Thanks.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Ankur Chadda, individual investor. Please go ahead.
Hi. So my question is with regards to the new pipeline for the commercial real estate. See, it's been like 4 or 5 years since Max Ventures was demerged, and all we've done is 4 projects, 3 of which were related parties. The land already belonged, or the project already belonged to the promoters. We just got 1 project, which was Max Square in last 5 years. And all we keep hearing every quarter or every other quarter is, oh, we are interested in Gurgaon, we are pursuing, we are evaluating. But there's no real new project which has actually come into the company. So what can we expect going forward? Can we expect at least 2 or 3 new projects within this financial year?
Sahil, you have to go on the different line.
Yeah, sorry. Rishi, Ankur, Sahil here. Thank you for that question. Firstly, in terms of the growth aspect, as you recall, when we started the journey of Max Ventures, we had two-pronged objective. One was to scale the packaging business, which we've been able to do from 600 crores turnover to now 1,000 plus crores turnover, from a 70, 80 crore EBITDA to a 200 crore EBITDA in the last year. So that's our journey on the packaging films. On the real estate business, we were very conscious about starting the journey in a systematic way to be able to wet our feet, so to speak, and to get the experience and build the capabilities before we hyperscale. So we've done Max Towers, we've done Max House, and we've done Max Square. As you will note, the combination of these three is a little bit over 1.5, 1.6 million square feet. As we are looking at it now, you are right. We have been looking at growth opportunities for the last year. We will continue to do that. We remain extremely conservative on the way we will underwrite growth opportunities for commercial projects. We are conscious that market may slightly contract due to work from home. So we want to be able to underwrite at very conservative numbers while offering a differentiated product experience. We will continue to evaluate opportunities in Gurgaon, Delhi, and Noida, and we are hopeful that in this financial year we will close a growth opportunity on the commercial growth side for office space. On residential side, we have just today announced that we will continue to look at it and we will evaluate opportunities. So I'm very hopeful that in the coming quarters, as Rishi outlined, we will have a few growth prospects for residential. So if I were to step back and look at it, there was a phase over the last couple of years where we tried to establish ourselves, build our capabilities. We are now shifting gears and moving into a phase where we will scale and build on those capabilities that we have built to drive significant value for shareholders from the real estate growth journey as well. Thank you.
Okay. So with regards to the residential real estate part, you mentioned that the IRRs would be upwards of 20%, right? That's at the project level or at the level?
That's right. Those 20% IRRs plus at every project level.
Okay. So this would be 20% at project level or 20% at equity level IRR?
Equity level IRR.
Equity level IRR.
Okay. And in terms of the asset services business, Max Asset Services business, there was a slide which mentioned that we're planning to take this to third parties now, in third party development, right?
Hello. So we will selectively look at third-party developments based on client profile and the building profile.
Okay. So how soon will this scale up? Like, is it like still we're thinking, or we actually starting to like now maybe go ahead and maybe at least take one or two third-party projects this year?
There are a couple of conversations underway. However, as you know, because of the lockdown, some of these conversations have been put at pause. We are talking to a few large groups where we will look at doing one or two pilot projects in our developments and then very selectively scale it up into third-party assets.
Okay. Okay. That's it from me. Thank you.
Thank you.
Thank you. The next question is from the line of Ulhas Paymaster, individual investor. Please go ahead.
Hi, my question is on this return of investment of 20-25%. Can you give more information on details how you arrive at 20% ROI on Max Tower and Max House, where the rental income is likely to be between 30 to 35 crores on Max Towers and around 10 to 12 crores on Max House? Because the overall investment on Max Tower was around, I think, 600 crores. A part of it has been sold. So can you give some more details, the breakup of what is the equity and the debt component on the Max Tower and the Max House project, so that the 20% IRR can be just seen how it works out? Thank you.
Sure. Thanks, Mr. Ulhas. So, Mr. Ulhas, I think we have to look at this journey into two parts. The first part of the journey was, as Sahil mentioned, that we are establishing our brand. in establishing our brand, the first project which we did was Max Towers. In Max Towers, we're not close to a return on equity of 20% on the project as of now, because this was something for us to showcase our ability on the real estate side. But as we go ahead and we come to a stage whereby we are stable, the new project which we are taking, something which we are taking like a Max Square, a project on Max Square, over at that point of time, we are targeting our equity IRRs in excess of 20%. So as we go ahead in a journey, the blended returns on an overall basis would be in excess of 20%. As far as Max Towers is concerned, being the first project, we have been able to re-rate the entire Noida market in terms of these rental pricing. Going forward, we expect this pricing to even increase the valuation, the valuation of the entire project, and increasing the IRRs for the project.
If I may just add one point there, I think the way you look at it is yield on cost. If we see Max Towers, we are somewhere in the range of 8.5-9% in terms of yield on cost. Moving forward, we will continue to grow and aspire to achieve 13 to 14% yield on cost. As we achieve 13 to 14% yield on cost, that will translate into a 20% plus in terms of an equity IRR.
Yeah, one more question out of that. Now, when the overall lease on rent on the commercial property is between 7 and 8%, how are you aiming to get a 13 or 14% yield on cost?
So the existing projects that you are saying are at 8.5-9%, but moving forward, like I mentioned, we are underwriting projects and we are acquiring projects where we will be able to achieve 13 to 14% yield on cost. That's our aspiration moving forward.
Okay, thank you.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Devendra Pandey from DP Financial Services. Please go ahead.
Good afternoon, sir. So my first question would be on our rental income. So what would be our internal projections for the trajectory of lease rental income for next 2-3 years? And can you give it some light on project-wise for this?
Yeah, Mr. Pandey. So, Mr. Pandey, currently we have got our Max Tower project, which is under lease in Max House Phase 1. And we expect, currently on the conservative side, we're expecting rental income to come in the range of 30 to 35 crores. Going forward in FY23, in FY24, we expect a Max Square to come on stream, the 7 lakh square foot of leasing. And we expect going forward to have Phase 2 of Max House also coming on lease. So we expect in total of close to 1.5 million square foot lease rentals accruing to us starting FY24.
Okay. And what would be the size of a residential project you are looking to have, and how that would be funded?
So Rishi, will you answer that? Rishi, will you take that?
Sorry, yes. On residential, as I explained, our vision is to add 0.5 to 1 million square feet of sellable area per annum. So we are looking to underwrite projects in that particular range. Exact numbers may vary from opportunity to opportunity. As far as underwriting and funding is concerned, underwriting, as we have always maintained, as we do in commercial office space as well, we underwrite pretty much where the market is and don't associate any premium for Max brand in our underwriting. And same is what we are doing for residential. When it comes to funding, exact capital amount required will vary, but we are very cognizant of the fact that as we are underwriting, that the sales cycle is also shifting a little bit back end, given where the market is. We're factoring that in our underwriting and capital requirement. And we will work with our institutional partners as we are doing in commercial office space to fund this particular project.
Okay. So what would be our capital allocation strategy between commercial and residential space?
I think both are stated, as we have also stated very clearly in our strategic objectives that we have outlined in the investor deck. both for commercial, office, and residential. Our aspiration is to add 0.5 to 1 million square feet per annum. Real estate being lumpy, actual numbers may vary year on year, but that's our on an average aspiration over next 5 years. And capital allocation will be keeping in mind that strategic objective that we have outlined for ourselves.
Got it. Thank you, sir. If I have anything else, I will join.
Thank you.
Thank you. The next question is from the line of Sachin Shah from SS Securities. Please go ahead.
Hello, am I audible?
Yes, sir.
Thank you, team, for giving me an opportunity. My first question is, would you be planning to have any equity fundraise in order to fund all these future commercials as well as residential developments?
Yes, Sahil here. We will definitely look at planning equity fundraisers in times to come as we look to scale the commercial office business. We believe that is the prudent approach to follow for the real estate business.
If I can just supplement that, we are planning to raise equity at the project level and not at the MAXVIL on the holding company level. We don't intend to dilute the equity shareholders of MAXVIL going forward.
Okay. And one more question with respect to packaging side. How much EBITDA margin expansion can be expected with respect to this higher specialty films volume contribution, you can say?
I'm not sure if we can pinpoint a number, but I can definitely say that our current growth, we've reached to a certain level. We should definitely sustain this and grow this with a specialty journey, but I would say we'll definitely go forward. I wouldn't really like to put a number at this point of time to say that, exactly what particular number. Yeah.
Okay. That's it from my end. Thank you.
Thank you. The next question is from the line of Jigar Shroff from Financial Research. Please go ahead.
Thank you for taking my questions, and congratulations to the team for excellent results for the full year. I had only one question. At what point of time would you consider splitting the company into the real estate division and the packaging film division to unlock value for shareholders? Thank you.
Right. Great question, Jigar. Thank you. Sahil here. Absolutely. I think our real estate business and journey is just starting off. You know the history of the Max Group. We have done that, successfully. When healthcare and insurance was all clubbed together, we were able to successfully spin it off and create substantial value for all shareholders. Our intent always continues to be to continue to add and create value for shareholders. The real estate journey right now is just in its early stages. I think we need to have a certain amount of scale in the real estate journey before we can consider or think about any of these alternatives. If you see the texture of what we're looking tone and what we're looking to do over the next few quarters this year and moving forward next year, you will see that we're looking to scale our real estate business. So I'm very confident that once we scale the real estate business, that can be a very interesting discussion to be had.
But in your judgment, your vision, should we anticipate something by, say, FY23, FY24?
I certainly am hopeful that in the next 18 to 24 months, we will be able to scale our real estate business here.
And it's then that you would consider...
Sure, we would. I think this would be a valid question to consider at that point in time. Yes.
Great. Thank you and all the best.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Ulhas Paymaster, individual investor. Please go ahead.
Hi, I have one more question. Since last 3 to 4 quarters, you have been mentioning that you are looking for the projects on the commercial real estate side. Now, I believe the real estate market is turning around, and I'm sure the prices could have gone up. So could you indicate what is the level of price increase which has taken place in the last 1 year in the areas where you're looking to expand?
Yeah, this is Rishi. So as Sahil explained, you're absolutely right. We have been on the lookout for last 1 year opportunity in CRE space, particularly in Gurgaon. If you look at, it's not that opportunities have not been there. There have been opportunities, and this is exactly the reason why in this deck we have also outlined a pipeline that we are currently evaluating. But what you will also appreciate is that we do not want to make any mistake that others have made in the past of aggressively underwriting it in the spirit of getting a project in our portfolio. So we are underwriting on a conservative basis. In terms of specific question around pricing, the good news is if you look at Gurgaon, particularly Golf Course Extension Road, the expectations of landowner were at very unrealistic level when it comes to FSI level pricing. It was in a zone upward of 4,500 to 5,000 rupees per square feet. Over last 6 months of our discussion, that has definitely got corrected, and that is giving us a lot of confidence for us to get the right opportunity at the right price in our portfolio in this financial year.
So am I to understand that the FSI pricing has not gone up at all in golf course area in the last 6 months?
No, in fact, the FSI pricing not gone up. Actually, the FSI pricing has corrected because of the distress, which is giving us confidence for us to enter at the right value.
Okay, but
I think the key point to note is it was at very unrealistic levels even at a pre-COVID. People were sitting at a very unrealistic level of pricing, which did not make sense, and hence much deals were not happening. Those levels are getting corrected.
I thought the real estate market is turning around in last couple of quarters. So you are trying to say that despite the turnaround, the prices have not gone up on the FSI level. Am I right?
I would say FSI prices have corrected to a more realistic level, which is good for people like us who would underwrite it on a build to lease basis and give us the opportunity.
I'd just like to add to that. You see, I think the point is, if one notices, there is a trend towards consolidation in the real estate space, and that trend towards consolidation is meaning that the consolidators or the developers who have the brand, who have the credibility and execution track record and access to capital are able to sell their inventory well. And thus, when we see that real estate is turning around, we are looking at it from the sales side. What this consolidation has resulted is that the number of transactions that have happening from a land basis have reduced because the number of people who are interested or able to buy now are much fewer. So we are believe that we are in the sweet spot where we as the brand Max have the brand reputation, credibility, able to sell, and at the same time should be able to close opportunities at conservative underwriting levels that we would like to ensure our very stringent IRR benchmarks.
Okay, thank you.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Jigar Shroff from Financial Research. Please go ahead.
So I just want to know what would be the EBIT for the specialty film division for FY21?
Nitin? Yeah, just give me a The EBIT for the specialty film for FY21 is close to 174 crores.
Okay. So, I mean, am I right in assessing that the patch should be approximately 100 crores for the specialty film division?
Yes, please.
Great. Thank you so much, and all the best.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Sahil Vachani for closing comments.
Thank you, everybody, for your patience and for hearing us out. Look forward to connecting with you next quarter, and please continue to stay safe and well. Thanks so much.
Thank you.
Thank you.
Thank you.
Ladies and gentlemen, on behalf of Max Ventures and Industries Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.